back. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. It is our first show of 2025, and we are going to focus today on what is my little favorite pocket of the markets, because on this first day of the new year, the really crazy moves, the really out there volatility is in the currencies world. And so the question that we are going to ask ourselves here today, after a blistering US dollar rally at the start of the year, is what in the world is this thing doing, and has it gone too far? Because as we unpick this, it doesn't seem to make a terrible amount of ready and obvious sense what is going on. And we have an opportunity here, perhaps, in the days ahead to see this move unravel and for there to be a trade opportunity in that unraveling, which we'll unpick here as we go. So first of all, let's start with a look at the intraday chart of the US dollar index, DXY. This is, for the record, mainly euro. The index was created before there was a euro, and so all of these big national currencies that were major currencies at the time, like the French franc, the German Deutschmark, the Italian lira, all got subsumed into what became the euro share of this dollar basket. And so now it is overwhelmingly euro with a smattering of other currencies. So don't take this as a perfect average of the dollar, but it nevertheless gives you an idea. The dollar was basically asleep for much of the holiday period. So we can see here, this is kind of the pre-Christmas week here, when a lot of these markets went on holiday. And we can see that the dollar did next to nothing this entire time. But come the beginning of 2025, and the dollar is off to the races. Sharp rally here of close to 1% at the start of the week. And we can see now, going from what this was, which was an hourly chart, so each bar is an hour of today's session, and back. And this is now a daily chart, so each bar is a day. And we can see here is today's price action in the euro. Just a blistering loss for the euro, and a sharp rally for the dollar. Not only does this rally mark a huge acceleration, but it marks a break from the range that's held basically since mid-November. There was very little here in terms of trend development. We can see we made a sharp low here in the second half of November, and then held at it through basically middle of December, did nothing for the lion's share of the holiday period. And now today, not only do we have a big update for the dollar, but it's a big update that takes the range out and ostensibly sets the stage for further dollar strength. It's a similar story in the pound, where, again, we have a very well-defined range, next to nothing that happens during the holiday period in the second half of December, and then sharp capitulation. Moreover, this is not a story that extends to other currencies against the dollar. So we don't, for example, over the course of today, find ourselves looking at a sharp move higher in the Aussie dollar, let's say. We don't have a sharp move higher in the Canadian dollar. The yen barely wiggles. And so we don't really have a story of generalized US dollar strength. Moreover, it's just Europe, and not even all of Europe. When we look at commodity currency Europe, Norwegian krone, say, not a big day. But the big European currencies, euro, pound, Swiss franc, they are all sharply lower against USD. So, needless to say, the first question is, well, okay, this looks like a breakout. It looks like we were in a range for essentially a month and a half, mid-November through to now. We've broken out of that range. Surely this must be the next leg in what is a trend that is developing. Should we be sellers of these currencies and buyers of dollars, or is this a fake out? Does this basically amount to start of year weirdness? And should we basically write it off and say, okay, hold on a minute, this is not something to chase? Moreover, might this actually be a buying opportunity? Might the euro have become way too cheap here after this shellacking? Might the pound have become too cheap, especially since these moves are not being confirmed in other expressions of the dollar's value against the non-core European currencies and against currencies that aren't European? So first and foremost, then, we need to figure out what in the world is going on. And the thing to start with, in my mind, is first, what is the logic behind the trend itself? If this is continuation of a trend that began, let's call it mid-September or so, and you can see that in the euro here, you can see it in the pound right there. If this is the next leg of a move, then what's the move all about? And we've touched on this before, but we'll just quickly review. There has been a dramatic shift in U.S. monetary policy expectations from about mid-September through November and into the end of the year. And we can see here that the lion's share of this change, this is the implied Fed policy path, and the snapshots here are the policy meeting that the Fed did in mid-September. That's this. Then the policy meeting in early November. That's the big dash. The policy meeting we just saw middle of December. That's the small dots here. And then the current curve here. So what we see is that there's been a significant hawkish rethink. So in September, we thought, or the markets were pricing in, that we're going to end up at about 2.8% on Fed funds by the end of 2025. This is December of 2025. Already by the time we got to November, so barely 2 weeks later, 2.5, 3 weeks later, we had this massive adjustment by almost 100 basis points, almost 4 rate cuts worth, where it looked like we're going to be closer to 3.8 than 2.8 by the end of the year. And we've talked about why that is, but we'll, again, review it here just so we know what in the world is going on, what the moving parts are, which buttons are getting pushed to make this happen. And we can see here that when the Fed came out in September, this was it right here, it gave the markets all manner of dovishness. It said, we're going to cut rates by 100 basis points in 2024, and here's half of that up front. They issued a big 50 basis point rate cut. They said there would be another 50 basis points with only 2 meetings left for the year, so not a long time to change their mind, and indeed delivered on those. So we actually got the 100 basis points. We then also got a forecast saying 100 basis points for next year. And that makes sense. The markets were calling for the Fed to be dovish because by the time this meeting occurs, the markets have been baking out more and more and more and more and more easing, because from about the middle of April, U.S. economic data was steadily deteriorating relative to forecasts. This is an index from Citigroup that measures relative U.S. data performance compared with expectations. So what this was saying was, look, U.S. economic data is getting worse and worse and worse and worse, and so we're going to need the Fed to be really dovish. But then by the time the Fed delivered on this, we'd already rounded a bottom and U.S. economic data was already starting to improve. And so the market said, okay, wait a minute. The Fed gave us all this dovishness, basically everything that we were asking for, but the game has changed in the background. Now it looks like we're actually going the other way. So now all of this extra stimulus that you're saying you're going to do, in particular the 100 basis points that are being projected for 2025, you're not going to be able to do all of this because all of the stimulus you're dumping on the economy here, 50 basis points up front, another 50 basis points at the last two meetings of the year, you're dumping it on an economy that's already improving as of late August. And so with that, you're going to get reflation, and you're not going to be able to cut as much because inflation and wanting to get to your 2% inflation target is going to keep you from doing that. And we see these dynamics. So here's mid-April. This is where this deterioration starts, right here. And you can see at the top here are inflation expectations as they are baked into the bond market. They start coming down. Interest rates, the 2-year, the 10-year, they start coming down. The US dollar in the green here likewise starts coming down. Because, of course, this amounts to a deterioration of the dollar's yield advantage. But then come September when the Fed delivers, again, we've already crossed back the other way in terms of economic data dynamics. And when the market reckons, okay, well, now this is too much easing, inflation expectations come back up, dollar comes back up, yields come back up. So the tempting thing to say, well, okay, if this is now the resumption of this, we would have to believe that, okay, the U.S. economy is getting hotter, and we're back to a stronger dollar because we're not expecting the Fed to be able to cut as much as the Fed seems to be signaling. We're going into a reflationary sort of dynamic here. Okay, maybe. But if we look at the performance of U.S. markets today, that does not add up, seemingly. So here's that massive euro sell-off. Notice the yen doesn't really follow. So the first thing would be, if this is a generalized dollar story about higher yields, you'd expect this to be more consistent. But it isn't. You'd expect yields to have moved more. But they didn't. It's a very modest move in the 2-year here, and at the long end, you actually have basically a goose egg. Finally, gold is up, which is a bit odd. Gold is not in the habit of rallying when interest rates are edging up. Certainly not in the habit of rallying when the U.S. dollar is up. Gold is a natural foil for paper currency, of which the dollar is sort of the main and the benchmark asset, not surprisingly. Close to 80% of global monetary transactions are settled in dollars, according to the latest data from the Bank of International Settlements, which is a kind of central bank for central banks that aggregates everyone's data. So it doesn't make sense to say, oh, well, this is just more of the same. This is the move from September restarting in the new year because we have everything back as it was. Everybody's back from vacation. It's just more of the same. We're back to our previously scheduled programming, as it were. Well, I don't know. Doesn't seem to line up in a world where the dollar is not uniformly strong and gold is up and yields have barely budged. Could make the argument that this is liquidation, that Stock markets are down. They're down for a few consecutive days here. Not down a lot, but down. And that implies a move to cash, and the cash of choice, because of its absolutely unrivaled liquidity in times of liquidation, is, of course, the US dollar. But again, you would expect this to be more uniform. You would expect for dollar strength not just to be concentrated in the European currencies. You would expect it to be everywhere. In fact, you would expect the yen to be particularly strong, because in those risk aversion scenarios, the one currency that does as well as the dollar, or sometimes even better, is the yen. So you would actually expect the yen to be stronger. But no. And even if you didn't expect the yen to be stronger, even if there was no carry trade unwinding that you extrapolated from a risk-off scenario more generally, then you would say, all right, fine, but at least then the dollar should be strong across the board. And it's not. Finally, you would expect Bitcoin to be taking a beating, speculative, volatile asset that it is, in a risk-off scenario. And obviously, that's not the story here today. So it's tempting to draw conclusions that what this is some sort of an extension of what was already there, or indeed some sort of a broader macro risk-on, risk-off dynamic, but it doesn't seem to line up that way. Moreover, it seems like the Fed's December policy announcement was two steps behind the turn in economic data dynamics, much like September's was, just the other way. So in September, we can see the Fed got very dovish, but by then the economy had already turned up. Well, obviously the Fed doesn't exist in a vacuum. It saw the markets repositioning for this. And so when it came back in December, it was more hawkish. It stretched out its 100 basis points for next year to run 50 basis points in 2025, another 50 in 2026, such that the 100 basis points that in September was going to end up being easing will now take through the end of 2026. That, of course, lines up with this adjustment. We already have an adjustment in a more hawkish direction from the markets. But by the time the Fed catches up, the economy, again, in relative to expectations terms, is already cooling. The economic data outcomes that we're getting are already getting softer. And so maybe, as we've posited here, what we're looking at is a top in yields and a bottoming in bonds. So you can see here, you don't really get much of a change in inflation expectations today. You don't really get much of a move in the bonds. We saw that here. But it's the dollar that's surging. So it doesn't seem to be that whatever this is more of whatever this was. This looks to be something else. Ditto for the pound. This was that hawkish dollar yield adjustment, but this doesn't seem to line up to be that. And so whatever this is, it seems vulnerable to a reality check. And we might get one as we start next week, because the next big piece of macro data that we are going to get on all of this is going to be Eurozone inflation. And here we can see that what we're expecting is that in December, Eurozone CPI went up. In this case, the expectation is that we went up from 2.2% in November to 2.4% in December. And to put this in relative terms, this would be the highest that we've seen since July of 2024. So it would be a 5-month high on Eurozone inflation. And we can see from the breakdown here, it's a little bit difficult to see when we look at it here, but we can look at the makeup in more detail. This is November's numbers. Most of this lives in the hospitality sector, and most of what's there in the miscellaneous bit is actually insurance. So insurance costs. And when we consider how Eurozone dynamics have worked, we've been in near recessionary conditions again in the Eurozone over the fourth quarter. And indeed, after an attempted rebound in the first half of the year started to fizzle once we hit the mid-year mark. But these kind of discretionary spending categories are still holding up. They're seeming to be impervious for now, anyway. And so it is certainly the case that the Eurozone economy is in a bad way, but inflation is going the wrong way nevertheless and is proving sticky even in those parts of the structure that should be more cyclically sensitive. Moreover, if we take a look at Europe's economic surprise index, we can see that we're very close to the zero line here. So we're a little bit under, but very close. So data is coming out very close to expectations, if not on expectations. So the conclusion then would be we're probably going to get something in the vicinity of this number or close to it. And of course, if we take a look at the way at least the euro has performed, it has been very much a creature of the yield spread. And indeed, there has been some divergence here because most recently, the actual yield spread between benchmark Germany for the Eurozone and the US has stopped moving in the dollar's favor. This was the big move in the dollar's favor here, which of course we saw right here. But that move's over. And the euro is still weakening, as we can clearly see. So this appears to be something of a growing disconnect. Now, does that make sense then to go in and buy the euro immediately? Maybe not. We don't really have a price signal and markets don't need to pay attention until they do. But it does appear like if we were to get an uptick in CPI that suggests the ECB is not going to be any more dovish than we already expect, which is about 100 basis points in cuts this year, and the turn in the dollar's yield structure might be all but done, at least for now, because the economy is actually already starting to argue against an ultra-hawkish view, then this might not be something to chase, but need something to fade, if maybe not yet, until at least some signs of this momentum ebbing appear. And that is macro money for today. As ever, we will be back starting next week to our regular schedule, Monday through Thursday, right after overtime, a show I co-host with Chris Vecchio and Dylan Radigan, looking at the Wall Street close and what is likely to follow. I'll be back on with Victor Jones for the Price of Truth on Tuesdays in the new year, on with Victor and Tom for First Call on Sundays, as usual, on with Chris for Futures Power Hour, Mondays and Fridays, writing for the news and insights portion of tastylive.com, and commenting at Ilya Spivak on the platform formerly known as Twitter, and most recently now on Blue Sky as well. Thanks for watching. Macro Money's back next week. Hope you had a great new year. Welcome to 2025.